Did you know that real estate has created more millionaires than any other asset class in history? For a lot of people, though, that dream feels completely out of reach. They think it's too expensive, too complicated, or just way too risky. But what if I told you that you do not need to be rich to start investing in real estate? You just need the right strategy and the right mindset. In this video, we're going to break down exactly how to get started in real estate investing, even if you have limited cash. We'll cover everything from rental properties and house hacking to REITs and creative financing. This is your step-by-step guide to building long-term wealth through real estate. So why real estate? Let's talk about why it's such a powerful wealth-building tool. First, cash flow. Rental properties generate monthly income that can cover your mortgage, build your savings, or even fund your next investment. Second, appreciation. Over time, property values tend to go up, typically around 3 to 5% per year, which is a fantastic way to grow your net worth. Third is leverage. This is a game changer. You can use other people's money, like a bank loan, to buy a large asset. A small down payment can control a massive investment. Fourth, the tax benefits are incredible. You can deduct things like depreciation, mortgage interest, and expenses, which often means real estate investors pay less in taxes than regular W-2 employees. And finally, real estate is a hedge against inflation. As the cost of living goes up, so do rents and property values, protecting your purchasing power. Now, let's bust some myths. You do not need hundreds of thousands of dollars to start. You do not need a perfect credit score. And you absolutely do not have to be a landlord yourself dealing with tenants and toilets. There are entry points for every budget and every risk level. Let's dive into our first strategy, house hacking. This is one of the fastest ways to get your foot in the door. The concept is simple. You buy a property with multiple units, like a duplex or a triplex, live in one unit, and rent out the others. You can even do this with a single-family home by renting out spare bedrooms. Why does this work so well? Your tenants are helping you pay down your mortgage. You could be living for free or at a seriously reduced cost, all while building equity and learning the ropes of being a landlord. For financing, look into an FHA loan, which only requires a 3.5% down payment and is perfect for first-time buyers. If you're a veteran, a VA loan could get you in with 0% down. Next up, Strategy 2, classic rental properties. This is the traditional path to real estate wealth. You can invest in single-family homes, which are generally easier to manage and have lower tenant turnover. Or you could go for multifamily units, which offer more cash flow and economies of scale. There are also short-term rentals, like Airbnb, which have higher income potential but require more hands-on work. When looking for a rental, focus on 3 things: location, cash flow, and condition. You want a property near jobs, schools, and transportation. The rent must cover all your expenses, and unless you're looking for a flip, you want to avoid properties that need major repairs. A great rule of thumb is the 1% rule. The monthly rent should be at least 1% of the purchase price, so a $200,000 home should rent for at least $2,000 a month. What if you want the benefits of real estate without being a landlord? That brings us to Strategy 3, Real Estate Investment Trusts, or REITs. A REIT is a company that owns and operates income-producing real estate. You buy shares in the company just like a stock, and you earn dividends from the rental income. The benefits are huge. The barrier to entry is super low. You can start with as little as 10. Your investment is instantly diversified across many properties, and it's liquid, meaning you can sell your shares anytime. Some popular options to look into are ETFs like VNQ or individual REITs like Realty Income, ticker symbol O. Feeling a bit more ambitious? Let's talk about Strategy 4, the BRRRR method. This stands for buy, rehab, rent, refinance, repeat. Here's how it works. You buy a distressed property below market value, you renovate it to increase its value, you rent it out to a tenant to generate cash flow, then you do a cash-out refinance to pull your initial investment back out, and you repeat the process with a new property. This strategy is powerful because you're essentially recycling your capital, allowing you to scale your portfolio very quickly. But be warned, it has risks. Rehab costs can get out of control, and refinancing terms aren't guaranteed. It requires excellent project management skills. Our fifth strategy is for those who want to invest passively in big-time deals: real estate syndications and crowdfunding. A syndication is where a group of investors pools their money together to buy large properties like apartment complexes or commercial buildings. A professional sponsor manages the entire deal. Crowdfunding platforms like Fundrise or Roofstock have made this accessible to everyone, with minimum investments as low as $500. The pros are passive income and professional management, giving you access to deals you couldn't do alone. The cons? You have less control, your money is tied up for a longer time, and it's not as liquid as a REIT. Before you jump into any deal, you have to know how to analyze it. You need to run the numbers. Key metrics to learn are the cash-on-cash return, cap rate, and gross rent multiplier. There are fantastic tools out there to help, like the calculators on BiggerPockets or apps like DealCheck. Now, how do you finance your first deal? Money is often the biggest hurdle. Beyond traditional loans like FHA and conventional mortgages, there's creative financing. You could explore seller financing, where the seller acts as your bank, or a lease option, which is like a rent-to-own agreement. There are also hard money loans, which are short-term loans based on the asset's value. And don't forget partnerships. Team up with friends or family. One person can bring the cash while the other brings the sweat equity. Once you own a property, you have to manage it. You can do it yourself to save money, but it takes time. Or you can hire a property manager. They typically charge 8 to 12% of the rent, but they handle everything, from finding tenants to fixing leaky faucets. Tools like Buildium or Tenant Cloud can also help you automate rent collection and maintenance requests. Don't forget the amazing tax advantages. You can deduct a portion of the property's value each year through depreciation, reducing your taxable income. You can also do a 1031 exchange, which allows you to sell a property and roll the profits into a new one without paying capital gains tax right away. And almost every expense is a write-off. Mortgage interest, repairs, insurance, you name it. But please, work with a CPA who specializes in real estate. They can save you thousands. Let me tell you a quick story. Of course, it's important to avoid common mistakes. Don't overpay for a property. Don't underestimate repair costs. Never ignore the importance of location. Always screen your tenants thoroughly and make sure you have cash reserves for emergencies. Real estate investing is not a get-rich-quick scheme. It's about building wealth slowly and smartly. So here's your beginner checklist. Choose your strategy, learn to analyze deals, explore your financing options, and automate management when you can. Most importantly, start small, think big, and stay consistent. You don't need to be wealthy to start, but if you stick with it, real estate can make you wealthy. Thanks for watching. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss our next video. See you soon!